The first number, 102 million ounces, is every single ounce of silver that COMEX has available right now, today, to settle futures delivery contracts. That is it. That is every bar sitting in approved vaults that is officially designated for delivery. According to official CME Group warehouse data confirmed by CoinWeek on February 11, 2026, registered COMEX silver has actually fallen below 100 million ounces, dropping to 98,138,005 ounces after a single day withdrawal of over 3.25 million ounces. Let me say that again so it sinks in. COMEX had under 98 million ounces of deliverable silver as of February 11th. Now the second number, 366 million ounces. That is the current open interest in the March 2026 silver futures contract. Those are contracts, legal, binding agreements, where someone on the other end is owed silver. 366 million ounces of silver promised, on paper, right now. First notice day. The day when holders of March futures contracts can formally demand physical delivery is February 27th. That is 11 days from today. So here's the paradox you need to sit with for the next 20 minutes. COMEX owes 3.5 times more silver than it actually has, and the clock is running. If you're watching this and you own silver in any form, ETFs, futures, physical, stop what you're doing and watch this. Because what is happening right now in the silver market is unlike anything we have seen since 1980. And unlike 1980, it is not driven by two brothers trying to corner a market. This time, it is being driven by something far more powerful: basic arithmetic. By the end of this video, you will understand exactly why COMEX is facing its most dangerous delivery crisis in 4 decades, exactly who is on each side of this trade, and exactly what the 3 types of silver holders should do right now. Let's go. Let me give you the full picture of what has happened in the silver market over the last 6 weeks, because it is extraordinary. On January 30th, 2026, silver was trading at $121 per ounce. It had just completed the most explosive 4-week rally in the history of the metal, a 60% surge in the first month of the year alone. In 2025, silver gained 146% for the full year, according to LSEG data. When 2026 opened, the bulls were in full control. Then, in a single trading session on January 30th, Reuters reported that the U.S. was pulling back support for strategic metals. Within hours, silver crashed from $121 to $76 per ounce, a $45 collapse, in one day. According to Bloomberg, it was silver's worst single-day decline since 1980. Let that sink in. The worst day for silver since 1980. And then, just 6 trading days later, on February 6th, silver was hit again, falling another 13%, sliding to $76.74 per ounce, according to CNBC data. The metal that had gained 146% in 1 year had lost more than a third of its value in under 2 weeks. Mainstream media called it a bubble popping, called it a meme trade gone wrong. The headlines you saw were silver crash, silver sell-off, silver wipes out gains. And here's what's interesting. Most casual investors saw those headlines and left. Here is the thing. Here's what they didn't tell you. While the price was crashing on paper, in futures markets, which trade in New York during U.S. trading hours, something completely opposite was happening in the physical market. On a single day in early February, iShares SLV Silver ETF recorded 1,023 tons of inflows, over 32 million ounces, the third largest single-day inflow in the fund's entire history. According to analyst reporting on the Jinlo Substack publication, that is not panic selling. That is institutional accumulation at lower prices. At the same time, Sprott Physical Silver Trust, PSLV, had doubled its capital raise capacity to $2 billion on January 20th, announced while silver was still at $110 per ounce, specifically to buy more physical silver bullion. At current prices, that $2 billion buys approximately 27 million additional ounces of metal that will be pulled directly from the physical market and vaulted. Now, before I take you into the real evidence, let me say, this channel called the March crisis coming. In our analysis before the new year, we highlighted that the paper-to-physical ratio at COMEX was becoming dangerous, and that first notice day in February was the critical moment. Everything we laid out is now unfolding, by the numbers. If you are new here, subscribe and hit the bell right now, because what comes next is going to matter to your money. Now let me show you why this is not over, not even close. To understand what's really happening, you need to understand that there are 2 silver markets. There is paper silver, futures contracts, ETF shares, certificates. You own a number on a screen. It trades 24 hours a day. It sets the headline price you see. And then there is physical silver, the actual bars, the actual metal, sitting in vaults, that someone has to deliver if you demand it. In normal times, these two markets stay close together. If you own a futures contract and want delivery, you get metal. The system works. But right now, those two markets are breaking apart, and the data from multiple independent sources proves it. Let me show you the first. According to official CME Group depository statistics, dated February 11th, 2026, confirmed by CoinWeek, COMEX registered silver, the only metal that legally counts for futures delivery, fell to 98.1 million ounces. In a single day, 3.25 million ounces were withdrawn from the registered category, and 4.7 million ounces were pulled from the eligible category. The drainage rate across recent weeks has averaged 785,000 ounces per day. Now here is the critical context. As analyst Carol Merks noted on X on February 14th, against that 98 to 102 million ounces of registered silver sits 366 million ounces of March open interest. Those are futures contracts that technically could demand delivery. The ratio is 3.6 to 1. For every ounce COMEX has, it is promised 3.6 ounces it doesn't have. Pay close attention. The burning platform analysis from February 7th, using official CME data, showed COMEX registered silver had fallen from 167.7 million ounces in October 2025 to 103.5 million ounces by early February, a 38% decline in just over 3 months. At the current drainage rate, only 85 million ounces may be in the registered category when first notice day hits on February 27th. If just 25% of March contracts stand for physical delivery, COMEX needs 91.5 million ounces. If the February delivery rate of 98% repeats, which is not unreasonable given that February 2026 saw 18.72 million ounces delivered from 19.11 million open, COMEX faces requests for 200 to 300 million ounces against available inventory of under 100 million. That's not a stress scenario. That is an impossibility. Think about what I just said. Now let me show you the delivery data, because this is where the evidence becomes undeniable. According to data from the burning platform and investor analysis citing official CME records, total COMEX silver deliveries in 2025 doubled from 2024 levels, from 203 million ounces to 474 million ounces. Every single month of 2025 saw higher deliveries than the same month in 2024. This is not a random spike. This is a systematic, month-by-month shift in market behavior toward taking physical metal. Then January 2026 happened. January is historically a minor delivery month, and yet market participants demanded 49.4 million ounces of physical silver in January alone. That is 7.27 times the January 2024 level, and 4.17 times the January 2025 level. In a historically minor delivery month, more silver was pulled from COMEX than at any comparable period in history. Why? Because sophisticated market participants were front-running March. They knew the delivery crunch was coming, and they secured physical metal before inventory shrank further. Crucially, in the first week of January alone, COMEX registered inventory declined by 33.45 million ounces, 26% of total registered inventory, disappearing in 7 days. According to investing.com analysis, on January 7th, JP Morgan issued 99% of the delivery notices for 8.1 million ounces through 1,624 contracts. JP Morgan, the world's largest commodity bank, issuing delivery notices, pulling metal from the exchange where JP Morgan is also one of the largest traders. Read that again. That should tell you something. Now let's go east, because this is where the other half of the story lives. According to 24/7 Wall Street, reporting on February 12, 2026, the Shanghai Futures Exchange shed 31.3 metric tons of silver inventory in a single day on February 8th, leaving it with just 318.54 metric tons total. That's a colossal drain relative to their already depleted pool. And here's the detail that should stop you cold. A billionaire trader identified as Bian Shiming reportedly holds a 450 metric ton naked short position against the Shanghai Exchange's 318.54 metric ton total inventory. That means one trader has shorted more silver than the entire Shanghai Exchange physically possesses. That is not a trading position. That is an existential risk to the exchange itself. Meanwhile, according to Bullion Star analysis and Trading Key reporting, Shanghai physical silver has been commanding premiums of $10 or more per ounce above Western spot prices. When the same ounce of silver is worth $10 more in Shanghai than in London or New York, the market is telling you something. It is telling you there is a geographic scarcity, that the metal flowing east is not coming back. Let that sink in. Now let me talk about lease rates, because this is the data point that most people ignore, and it is one of the most powerful signals in the entire story. Under normal market conditions, the cost to borrow silver, called the lease rate, sits around 0.3% to 0.5% per year. That is baseline, normal. In October 2025, London silver lease rates spiked to 39% annualized on a single-day peak, according to data shared by Bruce Ikemizu, former Tokyo Precious Metals Banking Director and current head of the Japan Bullion Market Association. Since then, they moderated somewhat, but by January 2026, according to Trading Key, silver lease rates remained at approximately 8% annualized, still roughly 16 to 25 times the historical normal. Here is what that means in plain English. Lease rates are the price someone pays to borrow silver. When that price explodes from 0.4% to 8%, or even to 39%, it means one thing. There is so little physical silver available that institutions are paying extraordinary premiums just to get their hands on it temporarily. When someone is paying 8% annual interest just to borrow silver for a month or two, they are desperately short of metal. Not paper, metal. This is not speculation. This is the price mechanism screaming at us. Now let me zoom out for a moment, because what's happening at COMEX is not in isolation. It is the culmination of 5 consecutive years of global silver supply deficits. According to data cited by Crux Investor and Trading Key, the silver market has run a deficit every single year since 2021. Cumulative shortfalls between 2021 and 2025 are estimated at approximately 820 million ounces, nearly equivalent to 1 full year of global mine production. Those missing ounces have been consumed by solar panels, by electric vehicles, by semiconductors, by medical equipment, by 5G infrastructure, gone into products, not recyclable in any meaningful time frame. Current 2025 mine production is stagnating at around 813 to 835 million ounces per year. Total demand exceeds 1.2 billion ounces. The gap, 300 to 400 million ounces, is being met by drawing down above-ground stockpiles. The same stockpiles that used to sit in COMEX and LBMA vaults. COMEX registered inventory has dropped more than 70% from its 2020 peak, according to Crux Investor. LBMA total silver holdings have fallen nearly 40% since 2021, according to Physical Gold UK analysis. Wait until you hear what's happening next. Now I want to show you the pattern, because there is a pattern, and once you see it, you cannot unsee it. The silver price crashes. The $45 crash on January 30th, the subsequent 13% crash on February 6th, did not happen randomly. Look at the timing. When did the big sell orders come in? According to LBMA and COMEX trading records, the aggressive short selling happens during U.S. trading hours, during New York market open. Not during Asian hours, not during London settlement. During U.S. trading hours, large volumes of paper silver contracts are sold. Prices fall. Headlines scream, silver crash. And simultaneously, during Asian hours, during Shanghai, Hong Kong, Mumbai trading, physical metal is being accumulated, withdrawn, vaulted, shipped. This is not a theory. It is documented in the data. Stop for a second. Think about this. One side sells paper, the other side hoards metal. One side creates supply out of thin air in a futures market where you can sell silver you don't physically own. The other side demands physical bars in allocated storage outside the system. This is not coincidence. This is the defining trade of our era. Now let me name the institutions, because you deserve specifics. On the accumulation side, China's sovereign institutions, after China formally reclassified silver as a strategic material and imposed export restrictions that fragmented the global silver supply. India's retail investors and mutual funds, despite some Indian funds temporarily suspending new subscriptions due to physical scarcity. Sprott Physical Silver Trust, actively raising $2 billion to purchase physical metal. Samsung C&T, which in October 2025 signed a mining prepayment deal, giving it exclusive rights to 100% of a silver mine's output for 2 years, bypassing COMEX entirely. And JP Morgan itself, which on January 7th issued the overwhelming majority of COMEX delivery notices, pulling 8.1 million ounces of physical metal out of the exchange. On the other side, paper shorts. Traders holding massive naked short positions, like the reported 450 metric ton naked short at the Shanghai exchange, betting the paper price falls while physical supply disappears beneath them. This is where history gives us a very important warning. In 1979 and 1980, Hunt brothers Nelson Bunker Hunt and William Herbert Hunt attempted to corner the global silver market by accumulating massive physical positions. Silver ran from $6 an ounce to $49.45 in January 1980. Then COMEX changed its rules mid-game, moving to liquidation-only trading, which forced buyers to sell and allowed shorts to cover. Silver crashed back to $11 within weeks. The exchange saved itself by changing the rules. Pay close attention to that historical precedent, because in March 2022, the London Metal Exchange did the same thing with nickel. When nickel prices surged from $25,000 per metric ton to over $100,000 within hours, driven by a short squeeze, the LME suspended trading and canceled billions of dollars in trades. They changed the rules. Shorts were protected. The exchange survived. COMEX has already begun following this playbook. Silver prices recently broke $83 before, according to 24/7 Wall Street, an artificially induced pullback due to COMEX changing its margin requirement rules. When margin requirements go up, leveraged long positions get margin calls and are forced to sell. Prices fall. Not because silver became less scarce, not because supply appeared, but because the rules changed. This is not a free market. This is a managed market. And the management only intervenes in one direction. Here is what they don't want you to know. Changing margin requirements can suppress the paper price. It cannot create physical silver that doesn't exist. It cannot fill COMEX vaults. It cannot make 366 million ounces of promised silver appear from thin air. The physical shortage is real. The lease rates are real. The vault drains are real. The delivery demands are real. As 24/7 Wall Street wrote on February 12th, the dam is breaking. The futures market's days as the sole price-setting mechanism may be numbered. One more time, 102 million ounces available, 366 million ounces promised, 11 days to first notice day. This is the part that should scare you, not because you should panic, but because you should understand exactly what you're looking at. The silver market has split into three islands, as Trading Key's analysis put it. Asia, centered on Shanghai, North America, centered on COMEX, and Europe, centered on LBMA. Each region is fighting over whatever physical metal it can control. China's export restrictions mean metal flowing into China is not flowing back out. In Japan, secondary market premiums on silver have at times surged to 60% above official prices, according to BullionStar. 60%. In Australia, dealers reported widespread physical shortages. In Britain, according to Physical Gold UK, popular products like the Silver Britannia were showing out-of-stock notices and multi-week delivery delays. The price on your screen said one thing. The physical market said something entirely different. Right now, watching this video, there are three types of people. The first type is scared. You watched silver go from $28 to $121. You might have bought near the top. Then you watched it crash to $70, and you're thinking, should I just get out? Take whatever I have left? Stop the pain? The second type is confused. You see prices crashing, but you're hearing about physical shortages and 366 million ounces owed. You don't know what to believe. The contradictions are too much, and you're paralyzed. The third type understands. You have been watching the structural data, the lease rates, the vault drains, the delivery numbers, and you see exactly what the price crash is. It is the last opportunity to accumulate physical silver at prices that do not yet reflect the physical reality. You are not panicking. You are calculating. Let me talk to each of you. If you are scared and thinking about selling, I want you to understand what you would actually be doing. You would be selling physical silver, real, scarce, deliverable metal, at a price set by a paper market that is almost certainly going to face a structural reckoning within weeks. You would be selling the real thing to lock in the paper price at its lows. Let me be direct. Selling physical silver right now, during a paper-driven crash while physical scarcity intensifies, is almost certainly a mistake. The structural case for silver has not changed. The deficit is real. The inventory drain is real. First notice day is 11 days away. If you are confused, here's the simplest framework I can give you. There are two prices. There is the screen price, set by COMEX futures, influenced by margin changes, by short selling, by paper flows. And there is the physical price, the premium dealers are charging, the lease rates institutions are paying, the $10 premiums in Shanghai, the out-of-stock notices at UK dealers. Right now, these two prices are diverging. In the end, one of them is right. Physical silver is a finite, deliverable, scarce thing. Paper silver is a number on a screen. Historically, when these diverge, they eventually converge. And it is the paper price that moves to meet physical reality, not the other way around. If you understand, you already know the action steps, but let me state them clearly. If you hold physical silver in your own possession, you are in the strongest possible position. You own the real thing, no counterparty risk. If you hold silver ETFs, specifically iShares SLV, understand that SLV is backed by physical silver under an allocated agreement, but it does involve custodian risk in extreme scenarios. PSLV, the Sprott Physical Silver Trust, has a stronger physical allocation model, and the Sprott team clearly believes the thesis. They are raising $2 billion to buy more physical metal right now. If you hold COMEX futures contracts and are considering standing for delivery, understand the process. Delivery is assigned by the clearinghouse, shorts decide when to issue notices, and you would receive warrants for physical bars held in approved vaults. But the key risk is this. What happens if the exchange moves to cash settlement instead of physical delivery? They have done it before. With nickel. With silver in 1980. Monitor this risk closely. Now let me give you the timeline as I see it. February 17th is today, and it falls on both Chinese New Year and the start of Ramadan. The consensus among analysts cited by 24/7 Wall Street is that the next wave of heavy silver buying resumes within days of this date, likely the week beginning February 23rd. Then comes February 27th, first notice day, the moment of truth. Contract holders must decide whether to stand for delivery or roll to May. At the current drainage rate, COMEX may have as few as 85 to 90 million ounces in registered inventory. If delivery demands exceed available supply, COMEX faces three paths. Allow cash settlement instead of physical delivery, which would be an implicit default. Import silver from London or other sources, which is possible but requires time and cost. Or change the rules again, raising margins, moving to liquidation only as in 1980. Then comes March 6th. Merckx calculated on X that at a pace of approximately 15 million ounces per day, rolling off the March contract into May, it would take 18 trading days from February 14th, landing around March 6th, for open interest to fall to a level potentially coverable by registered inventory. But that assumes the roll happens at that pace. It assumes shorts cooperate. It assumes no further vault drains. None of those are guaranteed. And beyond March, even if COMEX navigates this delivery month without a formal default, the structural problem does not go away. Silver is entering its sixth consecutive year of supply deficit in 2026. Industrial demand, from solar, EVs, AI infrastructure, nuclear power control rods, solid-state batteries, continues to grow regardless of what the paper price does. Samsung's offtake deal, locking up 100% of a Mexican silver mine's output for 2 years, is not an isolated move. It is a preview of a world where industrial users bypass exchanges entirely and go directly to miners. When that happens at scale, COMEX loses its role as the price-setting mechanism entirely. Analysts at ING, Saxo Bank, Bank of America, and HSBC currently forecast 2026 average silver prices between $55 and $68 per ounce. HSBC's Colin Steele specifically raised his 2026 forecast to $68.25, citing persistent physical tightness. But given the structural forces now visible, COMEX inventory collapse, China export restrictions, lease rate spikes, 5-year deficits, the actual path could look very different from those forecasts. In a scenario where the March delivery crunch forces a structural reset, where paper and physical prices are forced to converge, we could see silver retest January's high of $121 and potentially exceed it. A gold-silver ratio returning toward historically observed extremes, from the current 45-to-1 toward 20-to-1, at current gold prices above $4,800 per ounce, implies silver well above $100 and potentially toward $200. Those are not guaranteed outcomes. They are scenarios that the data makes possible. But here's what I will say with confidence. The silver market is being repriced. The paper era, where 3.6 ounces of promises existed for every physical ounce deliverable, is cracking. March 2026 is the first real test of whether that system can hold. And you now understand exactly what is happening. Most people watching CNBC, watching Bloomberg, reading mainstream financial headlines, they saw silver crash and moved on. You know the real story. 102 million ounces, 366 million ounces owed, 11 days. That is not a headline, that is an equation, and equations don't lie. What we are watching in real time is the collision between two systems. The paper promise system built over decades at COMEX and LBMA, and the physical reality system that China, India, Samsung, Sprott, and institutional delivery takers are demanding. When an unstoppable force meets an immovable object, something gives. For 40 years, the paper system won. Every time physical demand surged, rules changed. Margins went up, positions were liquidated, prices fell, shorts were protected. But this time the structural dynamics are different. 5 years of consecutive deficits have depleted the above-ground buffer. China has restricted exports. Industrial demand is structurally inelastic. Solar panels don't stop needing silver because the price goes up. The lease rate spikes to 39% were not a bug. They were the market telling the truth before the rules changed again. Watch February 27th. Watch what happens with March delivery demands. Watch whether COMEX announces rule changes in the coming days. Watch whether cash settlement language appears. That is your real-time indicator of how serious this has become. And whatever happens, remember this. The scarcity of physical silver is not a story. It is not a narrative. It is documented, reported, measurable reality. Draining vaults, rising lease rates, delivery demands at 7 times historical levels, and a billionaire with a naked short position larger than the Shanghai Exchange's total inventory. This is the most significant story in precious metals in 46 years, and most people are not watching.